All right, everybody, it's me again, Isaac Landau, here to teach you about managing credit. And if you're hearing this, that means you're in the last section of the budgeting, saving, and managing credit portion of the Student Empowerment Series. So let's wrap this baby up and teach you about how to manage credit. So let's get into it. First up, what is credit? Well, I like to think of credit, or at least the concept of credit, understanding it, and managing it as just another tool in conjunction with budgeting and saving that you're going to be able to utilize in the future, even now, to help build your wealth. But credit itself has several meanings. And one of those is that credit is a contract that allows you to borrow a lender's money with the understanding that you pay that lender back. Additionally, credit is also a measure of one's borrowing capacity, or how much they can borrow. And the more credit that one has, and the better that that credit is, which we'll get into later in several modules about credit scores, the more likely lenders are willing to lend you that money. But why does it even matter? Simply put, credit is kind of how the world works. Most people don't have $500,000 to just buy a house. One must borrow that money. And understanding credit is going to help you save money in the long run. Assuming that this is person A, who just gets a loan for $500,000. I'm not here to explain everything about loans, but this is just to highlight how understanding credit is going to help you in the future by saving money. And the one on the right is person B, who also got the exact same loan. And because person A had good credit and a good understanding of credit and how it worked, was able to get it issued at an interest rate of 4%, which I'm going to talk about interest rates in the next couple slides. And person B was only able to get it issued at 5% because they didn't have very good credit or whatnot, or just didn't understand it. Person B is going to end up spending $107,000 more for the exact same $500,000 loan. So you could put that $107,000 into renovating that house or whatever that you used to borrow that $500,000. So this is just to highlight a little bit. And this goes into time value of money, which is covered in the business certificate series, which I'm going to emphasize you obviously check out. But this is just an example to highlight how understanding credit is going to help you out. And it doesn't disappear. Credit shows up everywhere. It shows up in mortgages, car loans, just loans in general, credit cards. There's some specifics about student loans, which I'll get into later. But credit is going to be around forever because people don't have money necessarily up front to just buy the thing, so they're going to have to borrow. Now let's talk about interest rates. So understanding credit and getting a good credit score and whatnot is going to allow you to borrow money, but it's also going to allow you to borrow money at a lower interest rate in comparison to your peers or whatnot. Now, just stick with me on here because it might get a little muddy, but I'm going to explain it even more. But interest is the amount of money that you pay whoever is loaning you money in return for that loan, on top of paying the loan back. And so the lower the interest rate, the less money you pay to borrow that money. So an interest rate is simply a percentage that describes how much a lender charges a borrower. But there's some duality to this. And so let's assume we have a lender on the left, which we could say is a bank, and we have a borrower on the right, which is, let's say, me. And this interest rate is this percentage that describes how much a lender charges a borrower. Well, it also describes how much the borrower is paying the lender. So this interest rate is, this borrower is paying interest, and this lender is earning. Interest. And essentially, the lower the interest rate, the more money you save as the borrower. Now, understanding interest rates is fundamentally important to understanding credit and how the world works. And it's, glaringly obvious that like a lower interest rate is going to, cost you less in the long run. And so the business certificate series goes into more depth on the interest rates, which we could go on forever. But just in terms of understanding how this works, clearly the lower the interest rate, the more money you're going to be able to save. And so that's kind of all I have for this module. And we're going to get into module 2 on the next slide, where we talk about credit reports, credit scores, what exactly they mean, and I'm going to talk about the 5 C's of credit. All right, well, thanks, and we'll see you on the next one.
My name is Rick Haskell, and I'd like to thank you for watching this installment in the Student Empowerment Series. This series was prepared by students in the Bill and Vieve Gore School of Business as part of our outreach through the Center for Financial Wellness. I'm a finance professor here at the college and director of the Center for Financial Wellness. We've prepared the Student Empowerment Series to assist students in important elements in their life and their progression through the college, part of their Westminster experience, if you will. In this series, we take a look at financing higher education, we look at budget, credit, and savings, and we look at some of the more important elements of adulting. We'd like to invite you to follow us on social media at our Instagram, YouTube, LinkedIn, and Facebook sites. You're welcome to use the QR codes provided or simply go to this site. Thank you.